Verizon VZ Deep Value Stock Analysis. Imagine a telecommunications giant whose stock has barely moved in years, yet throws off a hefty dividend. That's Verizon Communications, a company often discussed as a deep value play for patient investors. In this 5-minute analysis, we'll dive into Verizon's financials, valuation, dividend stability, historical performance, peers, growth catalysts, risks, and even apply some Warren Buffett-style logic to see if Verizon truly is a bargain. Verizon's financials. Verizon is one of the largest telecom companies in the US, with annual revenue around $135 billion and net income about $17.5 billion in 2024. That marked roughly 0.6% revenue growth and over 50% higher profit versus 2023, thanks to cost cuts and improved margins. Despite its modest growth, Verizon's stock looks very cheap. It trades at roughly 9 times forward earnings, a fraction of the broader market's valuation. Its dividend yield is around 6.3 to 6.4%, making it one of the highest-yielding blue-chip stocks. Verizon also generates robust cash flow. In 2024, it produced nearly $19.8 billion in free cash flow, which is crucial for funding operations and those rich dividends. Deep value assessment, intrinsic value. At these valuations, many see Verizon as a classic deep value stock. How undervalued might it be? Using discounted cash flow models to estimate intrinsic value, various analyses suggest Verizon's fair value is well above the current share price. One DCF analysis pegs Verizon's intrinsic value at about $62 per share, roughly 35 to 40% higher than the stock price around $40. Another valuation source estimates a base case fair value around $58.59 per share. In other words, based on Verizon's steady cash flows, the stock appears to trade at a significant discount to its calculated worth. This potential margin of safety, the gap between price and intrinsic value, is a key reason value investors are interested in Verizon. Dividend stability and payout. Verizon's dividend is a central attraction for investors. The stock's yield sits near 6% to 7%, and Verizon has a long track record of maintaining and modestly raising its dividend annually. Importantly, the payout seems sustainable. The dividend is about 56% of earnings and 66% of free cash flow, a bit high, but reasonable for a stable, utility-like telecom business. In 2024, Verizon paid approximately $11.25 billion in dividends out of $18.9 billion in free cash flow, meaning free cash flow comfortably covered the dividend. Even in the first half of 2025, Verizon generated 1.5 times the cash needed for its dividends, providing a cushion. With a payout ratio around 60% and a commitment to incremental annual hikes, Verizon's dividend appears stable, a reassuring sign for income-focused investors who prize reliability over rapid growth. Historical performance and stock trends. Why is Verizon's valuation so low? In part because the stock has underperformed for years. Over the 12 months through mid-2025, Verizon delivered a total return of roughly 14.7%, which lagged the S&P 500's 18.5% return. Zooming out, Verizon's share price is around the same level it was many years ago, essentially flat or down in price over the past 5 to 10 years. Investors who held Verizon earn most of their returns from the dividend checks rather than stock price gains. In stark contrast, rival T-Mobile's stock has skyrocketed over 110% in the last 5 years by aggressively growing its subscriber base. And even AT&T had periods of rally but also suffered declines after missteps. Verizon's stagnating stock reflects concerns about its growth and a preference for flashier tech stocks in recent years. However, this lackluster past is exactly why Verizon now trades at a bargain valuation. It's an out-of-favor stock that could be poised for mean reversion if it can improve its outlook. Comparison to telecom peers. Among telecom giants, Verizon looks like the value pick. AT&T, which also offers a high dividend, trades around 13 times forward earnings and currently yields about 5%. AT&T had a dividend cut in 2022 and carries heavy debt and restructuring issues. T-Mobile doesn't pay a dividend and instead reinvests for growth. Its stock trades near 22 times earnings, a rich multiple reflecting superior growth metrics. Verizon's 9 times PE is the lowest of the big 3 carriers. Furthermore, Verizon's free cash flow yield is very high, on the order of 10 to 11%, whereas the telecom sector average is much lower. If Verizon can even modestly grow or simply maintain steady performance, there's potential for multiple expansion. meaning its P/E could rise closer to peers or its own historical average around 12 times. In plain terms, Verizon looks undervalued relative to both AT&T and T-Mobile. Growth catalysts: 5G, fiber, enterprise. Verizon isn't a high-growth company, but there are catalysts that could improve its fortunes. The first is 5G wireless expansion. Verizon has invested heavily in 5G network infrastructure and spectrum. In Q2 2025, Verizon's wireless service revenue grew about 2.2% year-over-year. It also added around 278,000 fixed wireless access subscribers in that quarter, reaching over 5.1 million total FWA customers. Fixed wireless is a new growth avenue. Verizon uses its 5G network to offer home broadband internet, competing with cable providers. Another catalyst is fiber optic broadband expansion. Verizon is in the process of acquiring Frontier Communications for about $9.6 billion, which would give it an additional 9 to 10 million fiber passings. If approved and completed, this deal will enable Verizon to reach many more customers with high-speed fiber internet and bundle those services with its wireless plans. Verizon is also pushing into enterprise solutions, leveraging its network's reliability to attract business and government clients for private 5G networks, IoT connectivity, and edge computing. Risks and debt levels. Debt is perhaps the biggest financial overhang. Verizon carries about $168 billion in total debt as of the end of 2024, a legacy of heavy spending on spectrum licenses and network build-outs. Its net debt is roughly 2.3 times EBITDA on an adjusted basis. This is high leverage, though still within investment-grade credit territory. Rising interest rates could make refinancing more expensive. Another major risk is intense competition in the telecom sector. The US wireless market is mature, so carriers mainly steal customers from each other. T-Mobile has been aggressive with pricing and marketing, and cable companies now offer mobile plans at competitive rates. Technological and regulatory risks also remain, from needing continual network upgrades to changes in FCC policy. And there's always the risk of Verizon being a value trap, staying cheap because growth never materializes. Warren Buffett, style value logic. Buffett looks for businesses with strong moats, stable cash flows, and fair or cheap prices. Verizon offers a needed service with high barriers to entry, reliable profits, and a depressed stock price. Its network and subscriber base act as a moat, though one that needs constant investment. The earnings yield is over 10%, and investors get a substantial portion of those earnings as dividends. While the debt load and industry competitiveness are drawbacks, they appear to be priced in. For a Buffett-style investor, this could be a patient, income-producing holding. Summary: Verizon represents a classic deep value stock today. It's a market leader in telecom with a wide customer base, trading at low multiples and near multi-year lows. The dividend yield near 6% is a major draw and appears sustainable. Valuation metrics indicate the stock is cheap, and intrinsic value estimates suggest substantial upside if Verizon executes well. Growth is modest and risks are real, but this is more of a get paid to wait investment. Potential catalysts like 5G expansion, fixed wireless home internet, and expanded fiber coverage could gradually improve prospects. For investors seeking income and capital preservation with moderate upside, Verizon fits the bill. This is not financial advice.